Not a problem.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Dr. Merav Ozair, global blockchain and cryptocurrency expert, to discuss if blockchain technology could potentially prevent future bank runs. It's great to see you as always, Merav. Welcome back to Trade Talks.
Happy to be here as always, and happy to see you.
All right, thank you so much. Explain to the audience, what is a bank run a consequence of?
Okay, so bank run, I mean, I think even the Fed, mentioned that in their paper 2018 or something like that. Basically, it's a consequence of rumors. People start saying, and it's not a new issue. I mean, people have been doing it, for hundreds of years. But back in the days, you have to, propose something in an advertisement, or it's a word of mouth, and it takes time until the rumor spreads. Today, all what you have to do is tweet, and within seconds, everybody knows about it. So it's a consequence of rumors. It's not necessarily. I mean, the bank can be solvent or not, could be insolvent, but it's not necessarily true. It starts with rumors, but sometimes as they say, that the prophecy, kind of like becomes self-fulfilling prophecy. So that sometimes happens, because if everyone, starts panicking and everyone is withdrawing money, then yeah, the bank becomes insolvent, because no bank, especially today, with this, and someone was saying to me, it wasn't the bank run, it was a bank sprint in the case of SVP, because the Silicon Valley Bank, because in a matter of a day, billions of dollars were withdrawn, like over $40 billion, something that is unheard of. I mean, the one beforehand that the Washington Mutual, it took them 10 days to get to withdraw maybe 10 billion. I mean, but we're talking about in a day over almost $50 million, $50 billion. That's completely mind-blowing.
Well, I mean, of course, back during the great financial crisis, we did not have social media and the digital applications to, execute transactions like we do today. But you recently wrote a piece for Nasdaq.com, and you pointed out that there are a couple of ways we can adjust to the advances of technology, like we had just mentioned before, with these quick bank runs and everything being so digital now. The first is to minimize balance at risk. What does that mean?
Okay, so this is something that the New York Fed have suggested. I mean, you'll see in my post, I give references, where to find this article, paper that they just put. So what they mean is that, the risk is that what they are suggesting is basically that, let's say you have $1 million. And there will be some kind of a percentage that will minimize, how much you can withdraw. So let's say you can withdraw only immediately, maybe 90% of it, and then 10% will be delayed. The delay also can be decided, you can get, then the other, 10%, maybe 45 days, maybe 60 days, depending. Now, on top of that, there's also subordinate. I mean, this amount that is delayed is also be subordinated to every other depositor. Meaning that, let's say there are, for example, there are two only customers in the bank. Let's say you and I decide, okay, I'm going to withdraw everything, and you are a good customer, and you decide, no, I'm not withdrawing anything. I'm still leaving it. So so let's say I can withdraw in the 90%, and then the 10% that is delayed. Now it is subordinated to you. So if anything happens with the bank, then you will not encounter any loss up to that amount that is subordinated to you, which I was not able to withdraw. And in that sense, there's kind of a game theory behind it, because what happens here is that if I'm no one would like to be like the first mover, because that you definitely gonna lose some of your money for sure if something happens to the bank. So it's kind of playing this game theory issue of, I don't want to be the first mover. I mean, if I'm the first mover, then I'm going to lose for sure. So it's kind of like trying, to build on that. I think that's what they're suggesting, which is a good suggestion, but it's still, as I mentioned, it lacks transparency. You still don't know exactly what is the situations with the bank, what exactly are the asset liabilities, the current asset liabilities. You're still deciding whether to draw or not based on rumors, based on some outdated information, historical information, because all what you know is the last quarter. Let's say if I'm now in May. So all what I know is the last quarter, which was
right.
at the end, let's say, of March. But within this, today everything moves so fast, and in 2 months, not to say in a week, everything can change. So I don't know really what is the current situation with any
Right.
any.
So well, you also suggest that liquidity risk management and financial services could potentially benefit from tokenization.
Yes. So what I'm suggesting is the following. So I'm saying everything is tokenized, basically. Because blockchain, provide a lot of transparency. As I said, still, even with the Fed idea, it's a great idea. Maybe we can do it in combination. I do believe that, this game theory idea is very good. It's always good, to play on people's behavior. But you still lack the transparency. So blockchain, provide transparency and real-time transparency. So if we tokenize all asset liabilities, so in real time, you know exactly what is the situation with not just a bank but any organization. So the rumors, have less effect when everybody knows what the situation is. Not only that users are more informed, the regulators are more informed. So, if something, we started, to go in the wrong direction, it can give maybe the regulators a heads up, maybe they should, act in terms of to prevent anything. So it's good for the regulator, good for the users, and it's even in my sense, it's also some kind of control that kind of put organizations in the right mindset. So if they know it, everybody's gonna see what they're doing. So it kind of forces them to behave in a sense.
Right. And then to wrap up here, do you think risk management teams could leverage AI as they think about modeling? Perhaps AI can see and predict things in the future that maybe humans can't.
Yes, definitely. I always say, every solution is a combination of technology. So yes, let's have this transparency. We know that we can have a tokenization of blockchain technology, but at the same time, so we can monitor everything with AI and give alerts. So if you see something, and let's say someone is not watching, the blockchain, 24/7, but the AI can monitor everything that is happening in real time and give you the alert. Let's say to your phone, you get alert, or something is happening, the liability is below X amount, or your amount, your deposit, your account is below it, and even the regulators can get alerts with that. So there's all kinds of things, and also it's good for the company, the organization itself, to use AI for their own risk management. So it could work for weather alerts to the users and regulators, and also provide risk management tools for the organization itself. So yes, we can definitely use that on top for sure.
All right, Merav, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Happy to be here. Thank you. Have a good day.
Thank you.